Here's the intro. Most healthcare platforms don't fail because of bad intentions. They fail because they repeat the same mistakes over and over again. Today here on The Operator, we're breaking down why healthcare platform business models go awry. And it's not just in physical therapy. This is happening in dental, primary care, ortho, everywhere. Larry's been watching this for 40 years. Same pattern, rapid growth, big valuations, and then collapse. So today, we're getting into why that happens, and more importantly, how to avoid it and learn from the mistakes. So Larry, let's start with this. You said something in your article that really stuck with me and jumped out. This isn't a private equity problem. It feels like we love to label the villains, but you labeled a statistic, about 5% of private equity. You think it's more of an operator problem. What do most people get wrong about that, private equity versus operator?
Yeah, so private equity is a form of financing your company. It's like bank debt or self-funding or going public. And in the old days, everybody went public, even if they didn't have any earnings, even in healthcare, because it was a form of financing your company. So PE is financing. It's an accelerant. It's not an arsonist. When a platform fails, everybody wants to point at the capital structure because it's a clean villain and it lets operators off the hook. It's like a red herring. But I've watched platforms collapse that never took a dollar of private equity, and I've watched PE-backed platforms that were reasonably well run. The difference was always the same: the operator, management team, alignment with their board, and all the ecosystem around that. Did they build system, or did they just acquire, just use the lever arm of buying something? Did they hold culture? Did they go and let it dilute down to nothing? PE compresses the timeline and may amplify the consequences, but the dysfunction exposes the dysfunctions were already there to begin with. They were just hiding behind a cheap cost of capital.
Yeah, and it looked good on paper, and then in practice, it gets pressure tested, and then you see where the leaks are. So let's talk more about this free money. You basically said a lot of operators looked smart because money was cheap for a good 10, 12-year period. How much of what we saw over the last decade was actually good business versus cheap capital hiding those bad decisions?
That's a great question. So I kind of, for the purposes of this series of articles, divide the world in two. If you look back in the day, we all believed that healthcare was recession-proof. People made investments or allocated more money towards healthcare platforms because it was believed to be resistant against any type of inflation. Well, the reality is when you can't increase your prices in response to inflation, which is what reimbursement headwinds are all about, and you have a very overregulated business, on top of that, you had the effects of COVID, which not only brought wage inflation, supply inflation, it brought immense shortages, coupled with operational headwinds that really created a much different organization. You had to lay people off during COVID, or they had to take the government's money for being laid off. All of those factors changed the game. Now, today, what I see is platforms trying to operate in a post-COVID environment with all of those lever arms being an impact like it was pre-COVID. Money is no longer free. Inflation's effects are very real. People are now all of a sudden asking for wage reduction. Reimbursement hasn't gone up. In fact, it's gone down 15 to 20%, depending on which payer you're talking about. So this takes even better operators, not blaming the playbook of private equity or anybody else. All of those things are the real impact right now.
And this is not vertical specific. You've seen this across physical therapy, dental, primary care, ortho, different industries, and somehow same failure patterns. So why do we let history repeat itself? These things play out in public. Why do operators keep making the same mistakes over and over again, even when we have the receipts?
Yeah, because again, they haven't changed their playbook. They're operating in a pre-COVID environment when it's post-COVID. You get access to capital, you acquire aggressively, you produce impressive unit counts. You tell a growth story to whoever will hear it, investors, analysts, even your own board, and you defer the hard organizational work because integration is slow, it's unglamorous, and it doesn't show up in a board deck. Then the capital environment shifts, reimbursement continues to be a problem, labor inflation hits, and suddenly the structural debt you've accumulated all comes due at once. We saw it in the 90s with Vicor and Med Partners. We saw it again in the PE era 2.0, so to speak, with Stewart and Envision. And then CVS and Amazon, these are public companies, spent billions rediscovering the same lessons. 30 years, three eras, I should say, one playbook. The details changed. The outcome, really didn't matter. And I think, I did the series on metrics. If I was going to go back and add one more week, it would be around the word growth, because growth means different things to different stakeholders.
Mm-hmm.
And oftentimes growth doesn't mean profitable growth. It might just mean revenue growth. Well, if you're in an area of software, for example, where your valuation metrics is top line growth, that's great. But in physical therapy platforms, healthcare platforms, it's all based on real cash flow, not fake cash flow. And growth shouldn't be measured in top line, because if you're buying things, you're naturally going to have for growth. That's the same mistake I see these unprofessional manager CEOs make. They say how much growth they've had, but if they have the same amount of revenue and they buy something that adds revenue to it and you call that growth, that is not growth. What you have to do is integrate properly and make 1 and 1 equal 2. And so you have to have a benchmark around your acquisitions that post 1 year or post 18 months, that dollar that you bought is now $1.30. What's happened in most of these healthcare platforms and even in the public companies, their dollar that they bought is now worth 50 cents. And the dollars that it took to buy that, the debt on that is suddenly due. And most of these businesses on a cash flow basis lose money every month.
All right. If I made you pick one, the most dangerous mistake, what's the fastest way to break a healthcare platform? Is it like centralization, compensation, disconnection from what the actual product is, the clinic floor? What is the most dangerous mistake you've seen repeated?
I think the most dangerous mistake is cultural erosion.
Wow.
When you start terminating founders for no reason other than you want to scale, when you start taking the entrepreneurial zest that got you there away, you start to run into no man's land. Now, operationally, you have to have the blocking and tackling right. You have to have integration correctly so that if you're buying something at $1, a year and a half later, it's worth $1.50. You have to make sure that your clinicians are trained and that you have a clinician-centric organization. And then you have to have what I call a healthy tension between over-centralization and decentralization. You want to put in great systems in place to make your therapists or your doctors or your dentists be able to flourish and thrive clinically. No question about it. But if you eviscerate them and start treating them like widget makers, and you start talking about all this scale and all of this, centralization, you just absolutely kill the golden goose. And I see that over and over again. And when we get to the 5 dysfunctions of all this in the second set of articles, you'll see that those are the 5 patterns that repeat themselves. In the last portion of those top 5, not a little bit of a spoiler alert, is that the financial structure, they just have too much debt. And so what ends up happening is they produce all of their revenues to pay for the debt. And at some point in time, with an increased inflation and increased interest rates, you no longer have dollars beyond what you have to pay the debt. That decreases your investment, it decreases your training of your therapist, and decreases cultural elements. And all of those things throw you into no man's land and over time dysfunction, where you then need a lot of restructuring because these platforms have gone awry. And in physical therapy, we've now seen 30 years of that. In physical therapy, I can name you a half a dozen companies that got to about the 80 to 100 million in EBITDA range and then fell off a cliff. All the same patterns. Those patterns emerge, not just in physical therapy and other healthcare platforms, as you'll see in episode 2.
Yeah, good series preview, but not just other healthcare platforms. You brought up outside of the silo of healthcare, CVS, Amazon, Walgreens, Rite Aid doesn't exist in my town anymore. Some of the smartest companies in the world, and they still struggled. What did they misunderstand about healthcare?
It's interesting. For many, many years, going back 20 years, I remember sitting around a table and a lot of really good executives would say, the best and brightest companies in the world, the Microsofts of the world, the Dell computers of the world. Now you would say NVIDIA and Google and all those. You say, why don't the great technology companies get into healthcare? Well, there's a reason they don't. The few that have tried, Amazon is one that has tried and is continuing to try. Remember that one of their first acquisitions years ago was drugstore.com or something like that, and that completely failed, is they seriously discount the regulatory environment that healthcare. When you have technology and you have all of these things going on, it's anti-regulation. Well, when you get into healthcare, it's, other than nuclear power plants, it's the most regulated environment, and they discount that, and you can't. Everybody thinks everybody else's industry is easy. And so primary care was thought to be, everybody was going to get into primary care. Even the financial companies formed a sector. If you remember when JP Morgan, these others did it, it all failed. It's just a very, very difficult business because there's a lot of blocking and tackling. And I think at the end of the day, it's because it's a relationship and it's a people business. You can't replace people with technology from a hands-on delivery of healthcare. And while you might have adjuncts through AI and radiology, for example, or you might be able to use AI to help you on your documentation or even help you on your diagnosis, it's still a people-to-people business. And I think that they forget that. It's not easy. As our current president said, it's complicated.
It's so simple when you're just at dinner on the back of a napkin saying, here's how you fix your entire industry. Let me map it out for you. Unless you've sat inside it, it might look simple, but it's not easy. It is complicated. So then let's flip it. What are the platforms that actually work do differently? What are the people who do it well? What's their secret sauce, or what do they look at and do well?
Yeah, said simply, buying things is not a very difficult competency. Right? You don't need to train a kid to go to a candy store and buy things. You don't need to train an adult businessman to buy a business. You can develop those competencies rather easily. The more difficult work is integration. And so the successful companies treat integration as an actual work product. They take pride in it. They say benchmarks around it. They have dashboards around it. The acquisition is just how you get across the raw material. The platforms that work, and there are some, are obsessive about the period right after an acquisition. When we did acquisitions, when I was running it, we did them over an 18-month period because we believe that you integrate slowly, not quickly. You onboard a practice into your culture just like you onboard a new employee. And you do that without destroying what made it valuable in the first place. I remember Bill Samuels of Maker's Mark always saying it, don't screw up the whiskey. You can be as big as you want as a whiskey company, but if you start messing with the formula, you're going to screw it up. That's what we tend to do in the healthcare platforms. But the ones that are successful have compensation models that were designed with clinical input, and they get revisited regularly. They don't commoditize and widget maker. They don't fire founders. They don't fire entrepreneurs. And the leadership is very real structured mechanisms for hearing from what I would call the clinical floor, not a survey. I really do believe whether you're a baseball manager owner, you ought to be player centric. If you're a healthcare platform owner, you ought to be dentist centric, doctor centric, clinician centric, because those are your golden goose. Those are the only way you make money is through the revenues that they produce, through the pen that they write prescriptions in if it's a physician, not a town hall. So you have to get down to the business there and have operational accountability that connects with what's happening in the exam room, not the other way around. None of this, by the way, is magic. It's just really hard work. And it doesn't make for a great investor narrative, which is probably why it's so rare.
Right.
You always want the shiny board decks talking about growth, not about integration or success or making $1 equals $1.20, a year later.
All right, time for a quick segment. This is called Operated. See what I did there? Operated. We're going to do a quick overrated, underrated segment. All right, so I'll throw out a term. You tell me whether it's overrated or underrated. Private equity in healthcare. Would you overrate that or is it underrated?
Grossly underrated. Without private equity in healthcare, you wouldn't have access to healthcare like you do now. You wouldn't have well-funded technology companies that have good EMR products. You wouldn't have supply chain issues. You wouldn't have a bunch of hospitals across the country. So seriously underrated. It's a small portion of a big picture, like 5%, but it is generally regarded in a critical way, unfortunately.
How about EBITDA as a success metric? If you've listened before, I think you know the answer here.
The answer is it's grossly overrated. EBITDA is a result, not a lead generator. It's a lag indicator.
Centralized decision making.
It is grossly overrated. If you have centralized decision making, you do not have a successful company. You have to have a healthy tension between what occurs centrally and decentrally.
Founder-led clinics, overrated or underrated?
Underrated. You could look at any business, as you'll see in part 2, and you're going to get 400 to 500 basis point of margin improvement when you have a local partner.
Growth through acquisition, overrated or underrated?
Overrated because it's the natural default. The default should be organic growth, same store, but that doesn't make for shiny board decks. Everybody wants to buy a new shiny object. In my belief, in the way I run things, is if you can't show organic growth, you shouldn't be in the business of buying things, because all you're going to do is ruin them.
Yeah, you don't have to teach a kid how to walk into a candy store and buy stuff. That's exactly. I remember I learned that real quick. Final overrated, underrated, professional managers running clinics.
Overrated. I think, the term professional managers is really now become tricked up resumes by search firms. And there is absolutely nothing wrong with engaging with professional managers. But what has happened is we've put so much weight into thinking people are professional managers. And I can give you more examples of where they've ruined companies than where they've helped them in healthcare platforms. Doesn't mean there isn't some unbelievable platforms being run by so-called professional managers. But give me a business where you got your entrepreneur founders involved in some capacity, offsetting strengths, all of those kinds of things, and I'll show you a business that is likely failing.
Now, show me how this shows up. How does decision-making getting disconnected from the clinical floor actually show up in real life? What does it actually look like? How do you spot it?
Yeah, so what happens is you commoditize your providers. And so what professional managers tend to do, and again, there are some terrific ones, so I'm spitballing here and kind of generalizing, but what I've seen in most healthcare platforms is over time, they think all providers are stupid. They think all providers should be doing nothing but generating revenue, seeing patients, maximizing their efficiency, making as much coffee as they can. Mm-hmm. When the reality is the impacts, the pressures that a clinician has every day between patients and insurance companies and EMRs and the regulatory side of it. And these folks have lives, and it's very, very difficult. It's why burnout exists in part, because you have so much externality pressuring them through the so-called efforts of professional managers. When you engage in a collaborative process, so here's what some professional managers do. They'll name a chief clinical officer. That is their poster child of, oh, we're very clinically oriented. And in fact, our chief clinician officer, he's hooked at the hip with our COO. And it's all bullshit. It is all it's all to make a shiny board deck. Look at the results. The results are what matter. If you have a results-oriented work environment around a solid culture built around your clinicians with good basic blocking and tackling and fundamentals, the metrics around healthcare are not that difficult. The execution is extremely difficult. And we oftentimes do not apply common sense in common practice. And those things in aggregate are what ruin healthcare platforms, as you'll see the evidence in part 2.
Compensation gets brought up a lot. You can make a big mistake there, and it can hurt you for a while, and you might not be able to recover. So what are the biggest compensation mistakes you see that end up driving clinicians away?
Yeah, so we tend to make centralization decisions around bonuses and compensation because it's easier for finance, accounting, legal, and HR team. You shouldn't make decisions based off ease for your administrative team. You should make decisions based off the best alignment with your clinicians. So we base it on units or visits or something that drives volume. never wondering whether or not payer mix makes any difference, whether or not this clinician has more patients that have higher comorbidities or higher complications. I do believe that the doctoring professions ought to have the clinicians making the most money through their ability to receive a percentage of the compensation that they produce. Now, I'm not saying that as a day one clinician. So you have to have a guarantee, if you will, a safety net as an onboarding, because clinicians are graduating from schools post clinicians and they need more and more training. So you have to upskill them and give them that year and a half, whatever it may be, so that you're not tying their compensation. You're giving them a guarantee, just like we do in a lot of other businesses. And then after that point, the way the clinicians generate their revenue is through their care. And if they're good care, they'll get good word of mouth, good patients, and they ought to receive a percentage of that. Right now, what we have, particularly in physical therapy, is you pay clinicians to progress and pay them more to get out of clinical work. We have the highest percentage of clinicians not doing clinical work in physical therapy than any other so-called ancillary that I've seen. Wow. We only have 20 to 25% on an FTA basis of PTs actually treating patients. Why? Because we pay them more not to treat patients. That has to be reversed. We want to be a doctoring profession, but we don't want the responsibility, the compensation models. And a lot of this I blame on professional managers. Most clinicians I know after a while want to be on within their own private practice of a practice, right? But the system doesn't let them, because the metrics and the operating platform are built around ease and shiny books and boardrooms. They're not built around what's best for the long-term sustainability of the practice.
What's your final shot? What's the thing you hope people take away from not only this first article, but from the series if they read through it?
Examine your own company based on the 5 dysfunctions. How are you performing? If that can change over time, it could really benefit you. It's all about the conversation and raising the sensitivity level. And why repeat these historical patterns of failure? The only way you can mitigate that is by having a check and balance system, having people push back, having people question things. All progress is made through deliberation, debate. And you have to have that within an organization. And you have to have people pushing back against, a so-called professional manager. Why are you firing founders and entrepreneurs just because you want to scale? Why are you making these great claims and hiding behind them and calling growth when our free cash flow isn't what it should be? Why are we not making the investments in clinicians because our cash is now tied up in paying the interest on the debt, not even the principal on the debt? Those kinds of things.
I think one main takeaway is healthcare is not like other industries. You can't fix it with money, scale, or spreadsheets. And to be honestly successful long-term, you need stronger operators who understand both the business and the clinical side. Don't screw up the whiskey. Who build the systems that support, not replace the people delivering care. The fact
and in today's post-inflationary world, you cannot operate the business the same way you did today like you did pre-COVID. And you have to mitigate against the dysfunctions that cause you to fail, but you also have to have better people around. You have to have better board members, not these so-called professional board members that hop anywhere, not because somebody invested a lot of money and they have a trust fund that allows them to be there, but they bring you nothing in terms of experience or expertise. And you have to have a healthy conversation around what works.
So if you're building or thinking about building a healthcare platform, what we talked about today and the rest of the writing is the stuff that actually works, not just growth, not just valuation, but whether the thing actually works. If this hit, share it with someone building in healthcare. And if you want more of this thinking, we'll give you the link to Larry's Substack, The Operator. That's where these ideas live first. Thanks, Larry.
Thank you, Bud.